Let's get into our results service now. We've spoken about Richemont in the markets commentary sector. Let's talk to a CEO of a company whose results have come out earlier today, and that is PPC. Revenue up 8%, normalised earnings per share up 4%, but earnings per share down 21%, but that was due to sort of accounting and money crunching niceties. Increase in SA and Zim cement sales. So although the results haven't really shot the lights out, there are signs of encouragement. In the Joburg Power Lunch studio is Ketso Gordhan, who is the CEO of PPC. Ketso, is that a fair assessment of what's gone on over this period? In other words, there's some signs of light because there's some demand in the market.
Yes, I think we were a little bit surprised on the upside on the volumes. We were expecting around 4%, so 6% is a nice small surprise. And you know, we had some challenges in the business around costs of electricity, a small technical problem at one of our major plants, which is now fixed. So the results would have been a little bit healthier had it not been for that. But yes, I agree with your overarching comment, which is that we are beginning to see that a 4 to 5% volume growth is possible in South Africa. The swing factor is clearly where the government's infrastructure program gets going in earnest, and that could be a significant swing factor.
Are you suggesting then that the increase in volumes that you've seen both in South Africa and Zimbabwe are more to do, in particular in South Africa, more to do with the private sector rather than the government infrastructure rollout? Yes,
in both countries, I think that the story is the same. More so in Zimbabwe, where I think a lot of the demand is almost informal residential, and no major government infrastructure programs until after the elections, which we hope will go well and allow us to increase our volumes in Zimbabwe. In South Africa, we are beginning to see some of the early stages of the government infrastructure program. There are some roads being built and there are some schools being built, but none of the big infrastructure program or elements of the program are yet in sight.
When I see results like I saw yesterday from SPAR, their Build It division not doing particularly well, and seeing Cash Build also not doing particularly well when I spoke to them about their last set of results, I think of PPC because obviously people go to those particular retail outlets and they buy their cement. But obviously these results that you've just published are showing that maybe there's a stabilisation. And also pricing is important because you've managed to increase your prices and pass it on to the customer. 4%, I think the number.
Yeah, we typically do a increase at the beginning of the year and the middle of the year. So we were able to put through a 4% increase in January, and we'll put through a slightly smaller increase now in July, so that over the year you can sort of annualize it at about 5 to 5.5%.
Cost of sales up 9%. What was that about?
Say that again, sorry.
Cost of sales increased by 9%.
Yes,
I mean, seems like quite a high number.
That it would have been lower. Cost of sales increase would have been lower had it not been for a technical problem at a major plant of ours, Dwaalboom, which accounts for probably about 2% of that 9%, bringing it down to 7%. The rest of the numbers are increases in the cost of energy, particularly diesel and electricity, which make up almost a third of the cost of producing cement.
A third of the cost. So how do you manage that? I mean, a third of the cost is a massive percentage. And when you see what we're seeing almost every month now, some announcement that this is going to go up and that is going to go up, although at the moment the price of oil is coming down, it must be difficult for your various departments, particularly your treasury, to actually manage this.
No, it's a sort of ongoing challenge. I think we are beginning to identify what we can do about it over the next 2 to 3 years. So step number one is we are one of the few cement industry players with multiple plants, which allows us an opportunity to try and optimize around our 3 most efficient plants, De Hoek in the Cape and Slurry and Dwaalboom in the inland region. And we are putting a lot of effort into rationalizing some of our operations so that we produce more at the more efficient plants. Secondly, we've got to think about producing a larger volume of cement using the same amount of clinker, which is the expensive part of producing cement. And we've had some technical innovations that have been tested and seem positive. And this will allow us to produce more cement using the same amount of clinker. So that's going to be an indirect energy saving. And the third area is really looking at alternative energy. You know, we are putting up a 60 megawatt wind farm in the Eastern Cape. We are thinking about reusing some of the coal dumps, the fines within them, to use in our production process, because we are one of the few industry players that can make use of this, which is a lot cheaper, and a number of other alternatives, including solar, to try and figure out a way in which we can bring that energy bill down.
Competition is something that has been in your mind for probably 3 or 4 years now, and we've been speaking to South African poultry producers about imports from other countries like Brazil. What about imports of cement from Asia? Is it still impacting on your business?
It still impacts on the South African cement industry. The main source of imports into South Africa is Pakistan. In fact, one particular player, Lucky Cement. And they have a cost advantage which allows them to produce the cement in Pakistan at about 30 rands a bag, which is, you know, half the price that it would cost typically to produce it anywhere else in the world. And they have about a 6% share of the cement market in South Africa today, but about 70% of that ends up in Durban, where the port is able to handle a different kind of cement delivery, and about 30% of it is split between the Eastern Cape in PE and Cape Town. So we are impacted by about 30% of the imports. They are competitive, you know, up to sort of 20, 30 kilometers from the port, and then they can't compete any further. So it's a very limited area in which they are presenting a competitive challenge to us, but it is a problem. And, you know, one of the things that concerns us going forward is government wants to introduce a carbon tax, which is going to be a significant charge for cement players, because half the process of making cement is a chemical reaction which creates the carbon footprint. And we are going to have to pay that tax while the importers are not. So, you know, the playing field might get even more unlevel than it is today.
There's also been talk about the quality of the cement that's coming in from places like Pakistan and China, but we haven't got time to go into that, Ketso. Let's talk about your Africa expansion very briefly, if you would. I spoke to somebody in the retail market yesterday, Spar it was, Wayne Hook, the CEO, and he said, we're not going to put down a flag in every single country in Africa just because everybody else is doing it. Your Africa expansion, is it measured? Is it going well? What are your prospects?
Yeah, I think it's going well. We've spent a long time preparing ourselves for this expansion strategy. We now have a very clear idea of which markets are favorable for us. In most of those countries, we have located a source of limestone of an adequate quality for us to produce cement. We have recently entered the debt capital markets and are doing a number of other interesting things in mobilizing the capital we will require for these investments. And thirdly, we've chosen our medium-term partner, EPC partner, that will build and commission these plants for us, and that's a company called Sonoma, who's done more than 100 of these EPC cement plants around the world, so have an incredible track record. So we now have all of the component pieces.